Tarun Mehta, the co-founder and CEO. Tarun, hi, morning. Great to have you on ET now. Tarun, how does it feel when the market rewards your stock with a 15% move after your earnings?
Thanks, Aisha. No, I think we have had a good quarter. Uh, Overall, EV demand has been reflecting up quite a lot for the last several months, and finally, we are leaning into it. There is, in fact, we had an 80% growth in Q1, uh, and we believe that growth could have been significantly higher if we can only ramp up capacity faster. That's what our attention and our energies are on, ramping up supplies, ramping up capacity. And we'll be supporting that with a new product launch later this month. So lots to keep us busy, and that's what we communicated yesterday.
Interesting. But, it's been a strong Q1 regardless, and I'll come to those capacity questions as well in just a bit. It's been aided by this structural EV demand tailwind. Would you say that this is just the beginning of the entire process? I mean, your quarter is clearly surprised positively. Is the underlying demand strength you're seeing purely cyclical, festive adjacent, or would you believe that EV two-wheeler adoption has now crossed a structural inflection point that is going to sustain through beyond FY27 and even further?
Very good question. So, Q1 is a very good quarter to answer that in a very clinical fashion. Q1 is not a festive quarter. Q1 is typically a lower quarter than Q4 because particularly in our industry in March, there is pre-buying that happens. So Q1 in many ways is generally a low quarter. In our case and in our industry's case, Q1 has seen a 44% surge in almost every metric. So no, I don't think this is cyclical in any way. This is a fundamental surge up. It's been driven by a few factors. The strongest of which I would say is this entire fear that's gotten created in the mind of the customer around availability of petrol. Petrol prices going up has helped, but the bigger concern that consumers now have is that is there a future in which they could be stranded because petrol availability could become challenging. So electricity is the more reliable commodity, and I think that's playing into this mindset that घर में एक electric गाड़ी होना चाहिए, for any scenario. So I do believe that this is a structural reset of the industry, and it's fundamentally driven by the consumer's confidence and the consumer's pull. So I do believe that the trajectory has changed. But even if you zoom out, despite such growth and despite such resets, all said and done, the e-two-wheeler industry is still only at 11% penetration, which means 89% of the vehicles sold are still petrol. So there's tremendous headroom for our industry. I do believe that underlying demand is quite materially higher, and we all need to lean into it. We need to launch more products. We need to build more capacity. We need to be present across more parts of the country, because it's not just the top 10, 20 cities that are buying electric. In fact, EV penetration is now materially higher in tier 2 and tier 3 towns. So I think it is a larger structural trend that's under play right now.
Tarun, hi, morning, Sajid here. You've always maintained that distribution is a key for sale of electric vehicles, especially two-wheelers. What is the kind of investments that you're making for distribution there? Because the moat that you carry is that whichever market you go, you try to be in the top 2 or 3 player there. So how are you looking at expanding your distribution here?
So distribution was our strongest lever that played out in FY26. We went from 350 stores to 700 stores, and it's easily driven at least 30-35% growth for us last year as part of the overall 60-70% growth that we saw. We do expect that a healthy scooter portfolio can possibly support 1,500 stores across the country. We are roughly about half of that right now. From our financials perspective, there is no investment required to open stores. They require no capex or any opex because these are 100% dealership run model, where it's our dealer partners who invest upfront in the stores. They carry the inventory and they take on the operational cost. So from a financial perspective, it will imply no investment from our side. We are currently holding up new stores for a few months because we don't have capacity to supply to them. But around festive, as the new plant starts going live, expect us to start opening up hundreds of stores very quickly. Overall, I believe over the next 2 years period, a doubling of store count is reliably warranted given the scooter portfolio we are walking into.
So let's address this capacity piece right now, Tarun. You've mentioned and prompted us literally time and again. How are you planning to ramp up capacity, and what's coming in between you ramping up capacity? Because clearly there's a lot of demand for you.
Yeah, you know, as a startup in a land of truly giant companies, we've always had to run with a lot of cost discipline. We can't afford crazy cost experiments. So we've always tightly managed our capacity investments, our supplier capacity investments, everything. So we'd gone from whatever 15,000 to 30,000 capacity, with the plant's maximum being 35,000. And as early as 8 months ago, we had forecasted maybe a 25, 27,000 per month kind of demand at this point. But demand's gone on a different trajectory. We are looking at about 50 to 60,000 units a month now. So we have obviously hit our capacity constraints. Luckily for us, we had started part of the IPO proceeds, a new plant buildup. This is happening in Chhatrapati Sambhajinagar in Maharashtra, where we are setting up phase one of a new 100-acre facility, which will go live by Diwali this year. And you will see volume output out of it in Q4, Jan, Feb, March. This will unlock an incremental 42,000 units a month. So the difference for us is we are not adding capacity linearly. For us, there will be a step jump. So there will be a little bit of a plateau for the next few months. But then there will be a big step jump, and we'll go from 35,000 a month to 77,000 units a month in literally just 4 or 5 months' time, which is the ramp up time for the new plant. So that's how capacity will go live. Hopefully, with that plant go live, we will be able to meet current demand completely. If there is excess demand even after that, we have secured more land as part of Aurangabad, Chhatrapati Sambhajinagar's new capacity, and we could potentially add another 42,000 units a month over the course of another year.
You have enough funds for that, the future expansion, should that be the case?
Sorry, Aisha, lost you there for a second.
No, I was wondering whether you're well funded for that, because for Shambhaji Nagar, you said that you have your IPO proceeds still earmarked. But what about the next phase of expansion? Should you need, to tap into it?
Correct. So for phase one of Chhatrapati Sambhaji Nagar, we had already earmarked funds from the IPOs. That's completely funded. For phase two, potentially we might need more capital, which is why a month ago we kicked off a 2,500 crore fundraise, out of which we've already raised 1,300 crores as part of a QIP, and we are just awaiting shareholder approval to close another 1,200 crores, a total net raise of 2,500 crores. With this 2,500 crores in the bank, we, I believe, are very well funded for any capacity increases like this, or even any fast tracking of new product launches. So I think on both fronts, I think we are well capitalized with this latest fundraise now.
Tarun, you said 1,200 crores more you're raising, or you're seeking approval there. Are we to see Hero participating in that round as well?
Yeah, this is already announced. So of the 1,200 crores preference issue, Hero is leading it with 960 crores. India-Japan Fund, part of NIIF and India-Japan Fund, is participating with 200 crores. And both founders, myself and Swapnil Jain, we are putting in 40 crores together.
Okay, another thing which is important is that you've been able to narrow your EBITDA losses over the last many quarters. Are we to see on an EBITDA level you turning positive by the end of this financial year? Because on a PAT level, there may be a higher depreciation because your new plant comes into play. So you might be having a net loss coming in there. But on an EBITDA level, are we to see an exit of FY27 on a positive note?
So, no, we've seen a very strong improvements in EBITDA trajectory over the last 4 or 5 quarters. In Q1 compared to Q1 last year, we were able to show a 1,600 bips improvement of EBITDA margin from negative 16% to positive 1%. That's including other income. Without the other income, it was, I think, minus 20% to I think minus 2-3%. So quite a substantial improvement there. This was driven by a very smart management of the commodity inflation. We were able to partly offset the massive surge in commodity prices with very healthy price increases across the board that the market was able to absorb. We also had a very cautious attitude within the company. So we had a very tight control on fixed costs. So together, both of them helped us deliver the strong EBITDA execution in Q1. A little bit of zoom out view on how we are looking at costs and how we are managing them. See, right now, our entire industry, most industries, most manufacturing industries are seeing a surge in input costs, input raw material costs because of commodity inflations across the board between the Hormuz war and and whatever's happened with semiconductors and everything. Uh, but every crisis presents an opportunity. We've leaned into that by raising prices wherever the market could take them, by rebalancing our portfolios with better and higher end SKUs, and finding and increasing our non-vehicle revenue, which has now grown from 13% to 14% of our total revenue. So all of these are structural gains. And while they only partly offset the commodity inflation today, I do believe the commodity inflation over the next 4 or 5 quarters will cool down materially. But the structural gains will likely continue, which is why I believe our gross margins have grown now, and they will keep reflecting over the next few quarters. That coupled with the disciplined focus on our fixed costs, I think we are headed for at least EBITDA profitability, recurring EBITDA profitability over the next 3 to 4 quarters.
Okay, good to hear that, Tarun, and great chatting with you. Thank you so much for your time today.